Joining us to discuss is Zoe Financial CEO Andres Garcia-Amaya and Joe Lavorgna, who is chief economist at SMBC Nikko Securities America. It's great to have you both here. Joe, let me just start with you because I know you share some of these concerns and are looking to see rates moving higher on the short end, on the long end, pretty much everywhere. Is that right?
Yeah, well, yes. I mean, in the short term, the bias is going to be for higher yields. Kelly, when the Fed cut 50 as we thought they would, the market tends to sell off because the market starts to discount faster growth, and we've had much stronger numbers. And about 70% of the move we've seen in yields from where we were when the Fed cut to now has been in higher real yields, which is reflected in the term premium. That is partly a function of better numbers, which we could talk about why we're getting the better numbers. I don't, with all due respect to Mr. Jones, Paul Tudor Jones is a great trader. I do not subscribe to his view that, you got to sell everything and the fixed income market isn't where you're supposed to be, because as bad as our U.S. fiscal finances are, if you look at Europe, you're seeing yields there significantly below where the U.S. is, with much worse long-term budget fundamentals. Right.
But so what is your argument that you would own parts of the U.S.?
Yeah, absolutely. For sure. Yeah, I think we could we could, depending on who's in office and what the policies look like, we could get rates moving back toward 5%. I don't think we'd meaningfully go above there. Interest rate differentials with Europe would be much too wide. And of course, as yields moved up toward 5%, investment grade corporates, which would provide a very attractive compelling return versus equities, would move up to 6. The equity market would correct, and then we'd undo any policies that were pushing us sustainably toward 5%.
I mean, in fairness, corporate credit is doing wonderfully. I mean, I think spreads are tighter now than at any point in almost the past 17 or 20 years. And maybe the spread with Europe is deserved because Germany's in recession, basically. So, I mean, there's...
Yeah, I'm talking, Kelly, on the 10 years. I'm talking 10 years, where the spreads there would imply they'd be much wider. And I'm saying that doesn't make any sense if U.S. yields were moved up to 5 or say 6%, given the spreads, say, Greece and Portugal, Italy, where they'd be 200, 300, 400 basis points. The dollar would massively rally, and that would abate any inflation pressure in the system.
Andres, you're not as concerned, I think, about what's going on with the financial system overall. I mean, you're pretty sanguine and see a lot of positive things that have been driving us to these levels. So you could buy stocks, you think, here? I mean, what's your kind of formula?
Yeah, one thing in the Treasury market that's important to note is that it's also different to buy a Treasury bond that has 4% yield versus maybe when it was at 2%. Like, there is some protection that you are getting a 4% coupon, right, versus when it was 2. So there's a little bit more protection, even if it goes up a little bit higher from where it is now. When it comes to stocks, my view is that just because we're at all-time highs doesn't mean that it should sell off, right? Especially if your time horizon is 5, 10 years out. I think there's actually a fair amount to be optimistic about why the market is going up high. One, it's earnings. Earnings are delivering. The other one is, which often gets talked about, is the Fed is cutting. The economy is not in a recession. It doesn't seem to be heading into a recession. And that's a pretty good recipe for the markets to continue to move up higher.
Even though valuations, this was the argument from Goldman's Costin this week, saying we should only expect 3%, average returns over the next decade.
Right. I think valuations start to become a very good indicator of what to do when they're at extremes, right? And yes, they're above historical averages right now, but it's not in that red mark of maybe where 2000, was saying, hey, this is now time to really consider valuation. And I think that note also implied that it was still going to go up for 12 months, but then eventually go down. For someone that's looking to invest 5, 10 years out, rebalancing would kind of take care of that in itself.
So it almost sounds like both of you think there could be a good entry point here for the 10-year. With yields where they are, you don't think, so you'd be comfortable owning it, Andres, at this, roughly at this level?
I would say that I understand why there are concerns that there upward pressure to yields. It's just a question of, is that upward pressure more than the 4% that you're getting on the coupon? And from that perspective, I'm not as concerned as I was before when it was with a 3 handle or a 2 handle.
Joe, do we need better talk or indications from either potential new administration on what they're going to do with the deficit and the debt? Would that help kind of tame the rise in long end yields, or at least kind of leave us with the good factors pushing it up and not the bad ones?
It's possible, Kelly. And also, I'm probably a bit less sanguine on the economy than others, even though growth has been better than expected. A lot of that has been deficit fueled. And I think at some point, the incremental dollar the government spending in terms of how it generates growth is going to dissipate. So I do think the economy will soften. And with that, Kelly, it should take down inflation expectations and should ultimately bring 10-year yields back down to 4%, which is basically where we see fair value. If yields were to move up substantially further from here, it would be a buying opportunity.
All right, Andres, what about gold and Bitcoin as have been outperforming? And you heard the case again from Tudor Jones this morning. Yeah,
well, one, that does indicate that part of the reason yields are rising is not just economic growth, being resilient. There are concerns about inflation, and gold usually is a pretty good proxy for that. Gold tends to be very much a momentum play. So it's one of those that, from where I sit, I don't know how to evaluate that outside of it's been doing really well, and I don't want to get in front of that, but I wouldn't necessarily recommend or have a very strong opinion about it.
Joe, a parting word on that? What do you think is behind the rise of both of these lately?
The gold to me, it could be partly inflation, although inflation expectations are pretty anchored. I think what's happening is you've got a diversification of central banks away from dollars, and they're increasing their gold holdings. And I think that's been a primary factor pushing gold higher.
That's been going on for quite some time, though. We have seen inflation expectations off the lows.
Yep. Well, I think also, too, the thing is the situation, the de-dollarization possibly within the BRICS and things of that sort, and central banks wanting to diversify away from dollars and perhaps treasuries is a factor. I don't know if that's as much as an inflation story. It is perhaps, Kelly, a geopolitical story. But I think that's certainly a reason. And, gold, I think, can rally. And real interest rates sometimes can fall. They don't have to move together. So, again, I don't think it's necessarily an inflation story.
Yeah, a lot of different things happening this cycle than we've seen in prior recent ones anyway. Gentlemen, thanks. Joe Lavorgna, we appreciate it. Andres Garcia-Amaya, thank you as always.